It is very important to understand what commercial real estate liquidity is in property investing. If you understand it, you can take advantage of future opportunities. If you don't, opportunities may come and you may miss out. Let's discuss this in more detail now. Firstly, what is liquidity in real estate? It refers to how easily and quickly an asset can be converted into cash without sacrificing and impacting its market price. In commercial real estate, liquidity is typically lower than stocks or bonds. The time and effort required to sell a property. You got shares, ring up your broker or go online and put a sell sign on it. Sell them instantly, in seconds sometimes, and get your funds in a couple of days. Bonds can be very similar. Property is different. You put property on the market, you've got to market it, you've got to prepare it for sale, you've got a marketing campaign, then you've got a period between the exchange of contracts and settlement. The whole thing could take 3 months plus, depending on the property and the market conditions. Location, property type, tenant mix, and market conditions influence liquidity. So, in bad market conditions, you may have trouble selling at a reasonable price. If you've got a bad selection of tenants, discourage a lot of tenants. So there's a lot of factors involved in liquidity. For example, commercial properties in remote towns, in smaller populations areas, can be more challenging to sell quickly than properties in higher populated areas. Over the last 35 plus years in commercial real estate, I have found that most commercial property investors rarely think about the importance of liquidity until they have to sell urgently due to partnership disputes, health issues, retirement, losing interest, becoming too much from, etc. This often results achieving inferior sales price compared to a property owner who is ensured that their property is in optimal condition to attract the best pool of buyers. There are reasons why liquidity is important for commercial investors. Liquidity is crucial for all investors. It promotes financial flexibility, allows investors to seize new opportunities, manage risks, and exit investments where necessary. A lack of liquidity can limit an investor's ability to respond to market changes, fund new projects, potentially leading to reduced returns or forced sales at unfavorable prices. The thing is that I keep saying, have a plan for the property when they buy it. Obviously have a plan to improve it and have a plan at some stage to sell. Having the property in optimal condition means that it's more appealing to new investors and usually means easily sell at the best possible price. I can't emphasize that any strongly. Liquidity is also important with new opportunities that may emerge, such as lucrative property and or business opportunities, and may be able to produce a better return. An analogy I use to express this is that property investment is you're playing a game of soccer and your team was attacking the opposition and you had the ball and you're approaching the goal line and you had players outside you. You knew where the opposition was. You had to make a decision on the spot whether you should hold on to the ball and try and go for the goal yourself or pass it to your teammate who may have a better chance of scoring. Property is no different. If you're in a situation where there's a better opportunity in somewhere else to buy another property, you may be better off buying that property. If not, you're better off keeping your property and improving that. Depends which is getting the best return. I cannot believe how many times I've seen investors hold on to a property for a long time when they had opportunity to make a lot more money in buying something else that offered a much better return over a similar term. They hoped for a better price, and in all cases, which would have been recouped quicker by moving on. So, for example, they might have only made $100,000 income of that property by keeping it, whereas another property they could have made 3-4 times that amount. Period. So they didn't pass on the property and taken up the new opportunity because they were stubborn and they wanted to get that price they wanted, end up losing in the long run. It happens a lot. The common challenges in commercial property investment: long transaction timelines due to property valuation buyer negotiations and legal processes, market saturation, or low demand for specific locations, which can prolong sales. Unique property features that will reduce the pool of potential buyers. So you may have in an industrial situation, for example, you may have a food manufacturing industrial place, which got refrigeration, and limited to that sort of people, unless you sort of strip it all out to cater for someone who was making a place which was selling online goods. Most commercial properties have specific type of tenant. When I look for an investment property, I like to refer to a utility property. It's a property which can have several uses, so which can be easily repositioned. Economic cycles, interest rates, and investor sentiment directly impact liquidity. High demand markets with strong economic activity often higher liquidity. Meanwhile, low demand makes it more complicated. Property type and tenant mix. Different property types, e.g. retail, office, industrial, hospitality, health, have varying demand levels, as we've seen with COVID, for example. Pre-COVID offers reasonable good investment. People started working from home. They come back to offices now. Who knows what will happen in the future? Industrial weren't that were investments beforehand. And what's happened? The online businesses boomed. Suppliers need warehouses to store their goods, and they become the major flavour of the month at the moment. Hotels, tourism almost died during COVID. Now tourists are coming back. They're becoming more popular, more lucrative investments. Things change all the time. You got to reposition. Liquidity allows you to jump to new opportunities as they start, rather than being at the end. When everyone else has gone into it, the price has gone up, as we're seeing with industrial at the moment. Strategies for enhancing liquidity: optimising property management and tenant relations, maintaining high occupancy rates, and with reliable tenant improves a property's appeal to potential buyers. Offering flexible lease terms or incentives can attract quality tenants. So you must manage the property well, normally with good quality investments to attract an investor. It's good to have long leases. On the other hand, if the property is being recently rezoned or ripe for future development, then more appealing to have shorter leases, because to get the optimum return from the property, you've got to vacate the property, redevelop it to attract a higher paying tenant or business use. Strategic property repositioning and renovations. Upgrading or repositioning properties can make them more attractive. For instance, developing retail spaces into mixed-use developments can increase demand and liquidity. Another way is to diversify your investment portfolio. Investors can enhance portfolio liquidity by balancing highly liquid assets with traditional real estate holdings. Fractional ownership or crowdfunding platforms can also provide partial liquidity or retaining some ownership. All these funds, that sort of thing. You can get into it that way if you want, rather than buy individual property. Partnership, where you have a smaller share, you diversify more that way. Spread your money around a bit. Some real world examples. Over the last 35 plus years, we had, for example, a targeted leasing strategy. We repositioned a motel by renovating it to attract a training college company, achieving a high return and consequently 50% capital gain in a short period of 24 months. Warehouse conversion. Worked with a client, transform an industrial warehouse into a retail residential mix development, achieving a record sales price for the inner Sydney suburb, which repeated other properties, obtaining significant capital gains for the clients. So redeveloping, bringing them. Another situation, we had a client with 2 hotels, a total of 6 rooms. We managed to strata each individual room so they will become individual titles, and we sold them individually for investors nationwide, some worldwide, overseas. Selling them all, giving the company enough finance to redevelop an underutilised car park into apartments. Really that way, rather than trying to sell hotels. Another situation, we had some properties for a client which were in the clothing warehouse manufacturing industries. that industry was dying in the area. So we positioned these warehouses to attract the design market, with substantial increases in rental income over the following years. In our book, Commercial Real Estate Investing for the Residential Investor, the 7 myths of commercial real estate explained, we go through more examples of how we have helped clients like yourself increase liquidity with substantial gains. Clients, maximising your returns through liquidity. The importance of a proactive approach. Managing liquidity ensures readiness for unexpected opportunities or challenges. Regular assessing your portfolio helps clarify and identify underperforming assets that could be sold strategically. Depends on your experience and the people you work with. Not sure, get someone who understands to help you with it. For example, we have clients with rundown properties needing major refurbishment and have the cash flow to finance the upgrades. Undertook a feasibility study to determine the highest and best use, and we repositioned the property as a commercial, retail, residential development site. Went through the process of package, going to council, get approvals, design the right development to maximise the area we're allowed to under the current zoning, and sold it for a nice little profit rather than keeping and underperforming industrial property. Incorporating strategies such as shorter loan terms, sale leasebacks, or crowdfunding into your investment plan to maintain finance flexibility while maximising returns. Regularly monitor market conditions to time sales effectively. So at the height of the market, people wait for things to keep improving, the prices go up. They're the last in the queue. They're in a situation where the property is about to fall again. So timing is perfect. Really keep your eye on what the market is doing. Plan and index is tailored to each property. Each property in your portfolio. How am I going to get out of it quickly if I need to? What do I have to do to ensure that property is liquid? How can I take advantage of opportunities that come along? Commercial real estate investors optimize their investments by understanding and actively managing liquidity while ensuring financial flexibility. If you have any comments or questions, leave them below, and please subscribe to this channel so I can have more videos like this for you.